Hi guys, welcome to another week. It is just me this week, but the format will stay the same. I'm going to talk you through this week's economic and geopolitical data, but I'm also going to cover the section that Andrea normally would with this week's equity requests. So of course on the geopolitical situation we do have to kind of touch on the ongoing conflict with Russia and Ukraine. You would happen to think the way markets have reacted this week, bear in mind the US has had its best week since November, you would kind of think the situation is over, and that's obviously very far from the truth. Pretty much even just over the weekend we've had now hypersonic missiles flying around, and this was to target weapons shipments into Ukraine that had been received from the West. I think the worrying bit about that is it's the same type of missiles that are capable of carrying nuclear warheads. So despite what has been a lot of positivity in the markets this week, it's easy to forget that there is still quite a conflict going on, and that conflict, the longer it goes on, we're 3 weeks in now, the longer that goes on, the impacts will really be felt by global markets going ahead. I think we can expand on that a little bit further. Currently there are, within the UK, 115 companies that have expressed concerns that the ongoing conflict will negatively impact their business. I think the worrying bit about that is none of them have actually came out yet and quantified what the negative impacts will be. But you're looking at some quite big companies in this list. Obviously BP and Shell, JD Sports, British American Tobacco, Imperial Brands have all expressed really grave concerns. It's a mixture of companies being under pressure in terms of cost and price, and these concerns were there even before this conflict broke out. I think we've had updates from Fevertree this week, who are concerned about commodity prices going ahead, and also Ocado expressing concerns regarding inflation. We have kind of searched to see, to try and find an upside. The only company we can really find that would benefit from this situation is Ferroalloy Resources, and they will benefit in the sharp declines in the Russian and Kazakh currencies, which will reduce their operating costs. We'll not go too much into detail for that, as I think it's getting released as this week's Trade of the Week to Instagram, where there'll be the usual in-depth 60-second audio analysis. Again, we're just going to stay focused in the UK for a little while. The inflationary pressures are really coming from tight labour markets. That's really a main driver of inflation at the moment. Bank of England Governor this week highlighted the competition for demand for labour. The problems that this is creating in terms of how it will affect equity markets and the UK equity market is the problem is predominantly within the public sector. Public sector has seen huge recruitment over recent months, going back as far as kind of late summer, early autumn last year, and this has really pressurised recruitment into the private sector. Unemployment on a whole in the UK still stands at 3.9%, incredibly low, and this creates your wage squeeze. Wages are up 4.7% within the private sector and only 2.2% in the public sector. Obviously increases in regular pay, and like I say, with that falling on private sector companies, this obviously at the end of the day impacts profitability. So this week central banks have obviously been in focus. Bank of England pushed rates for the third consecutive time, another 25 basis points, taking the base rate to 0.75%. Bit of something to note on this one, it wasn't a unanimous agreement on the vote, unlike the previous two. There was only one person who voted against it on the Monetary Policy Committee, but neither way, that 8-1 vote was taken as a bit more of a dovish signal, and obviously markets kind of pushed forward on the back of that. The Bank of England certainly isn't done yet, and rates will continue to increase throughout the year. Over in the United States, the Fed, we've had the guessing games for weeks. Would it be 50 basis points? Would it be 25 basis points? The consensus was it would be 25 basis points, and that's exactly what we got. That will be the first of many rate increases this year. So kind of on a numbers basis, what we're looking at is 25 basis points this week. That will be the first of 7 rate increases this year, and then a further 4 in 2023. That would get us to 1.9% year end and 2.8% by the end of the tightening cycle. That number is at the higher estimate of the long run neutral rate, and that will lower growth forecasts. The inflation is now running hot into other sectors that so far haven't been affected. You know, it's at this point it's been very much focused on energy and autos, but this is now filtering across all sectors essentially. Your core PCE estimates have been revised, and this is a revision from only December last year, so this is how quickly things are moving. Revisions are up from a year-end core PCE of 2.7%. That's been revised up to 4.1%. That's a huge difference on a revision over such a short period of time. And essentially this is all being done to try and central banks are now moving in an attempt to manufacture a soft landing. This has never been done before. It's going to be incredibly difficult that they can pull this off without things slipping into recession. So where I'm saying growth forecasts will be lowered, there's really a really strong chance that them forecasts will be revised negatively. And obviously that will have impacts throughout all your markets globally. We personally still believe it's not aggressive enough, early enough to curb this. Inflation data next month in the States will be pushing 10%. The Fed are still wanting to see inflation easing through basically growing supply and easing bottlenecks. Again, we see it as that's very unlikely, and the Fed in 6 months' time could be looking as foolish on this stance as they were with their transitory stance of 12 months ago. So there's a few requests to get through this week. Again, as always, thank you for your requests. We're going to begin with industrials company Ferguson. Current PE at 16.09 and we have forward multiples at 17.56. Dividend yields at 1.66 aren't great, but it is 24% 5-year net growth, and that should be set to continue. There is room for underlying asset price growth as it's eased back from its 52-week highs at £13.64. The company is citing inflationary concerns, but targets basically a growing market share within the US. You can expect organic growth to its North American plumbing and heating business, which will further expand through M&A activity throughout 2022. 2022 revenues, 2022 revenue growth at 16% year on year, and we would like to see consistency in them growth numbers. They have been a bit scattered over the last 5-6 years, but essentially for 2022 it's 8.1 billion of gross profit. 8.1 billion of gross profit will be a company record. and that translates to 1.83 billion of net profit, pushing EPS to 8.33. They're not the most exciting company in the world, but they are very good at what they do, and stock pushing to new highs would be expected throughout 2022. Next up on the request we have ChargePoint, which is a holding company that provides EV charging solutions through its subsidiary companies. It did become value trapped kind of last summer when price was around $36, and that has eased back to around $18 right now. Bit of note, that $18 price we're at right now is up 60% over the last kind of 3 weeks. The recent price action is typical of the wider SPAC sector, so don't think that upward trend is about to take off. That's a lot of retail buying hype right now. Perceived price has been very low and people trying to get it out again. It's not indicative to sudden improvements in company performance. Revenue growth is strong, up to 470 million in 2023, but margins aren't really exciting at all at around 22%. That would mean losses widening even into 2023 at around minus 260 million, leaving EPS firmly negative at minus 0.83. There is a lack of debt that the company carries, and that's obviously a positive during what we have going forward, but it at least provides an opportunity for the company to deliver on what it says it will be able to do. Like I say, I think the main thing with this stock is don't get caught up in the hype of price moving northwards for now. It's not professional money that's returning to the stock. It is simply retail money that is coming in right now. You're still paying excessive premiums for promises of revenues and profits that are still years away. Moonpig, I think most people know what Moonpig is, or they've heard of it. It's the UK listed online greetings platform. Asset price has been under extreme pressure, down 60% near enough since last summer. There's no surprises that the asset price has struggled. It's the number of institutional sellers that are active at the moment. Number of institutional sellers has increased more than 150% since last summer. And during the time we are now, until they begin to exit, share price will remain suppressed. There was an 8-day losing streak in February. That contributed to 13% losses. And it's just indicative of recent IPOs, as funds are really kind of trying to target track records and stability through what is a difficult time right now. The balance sheet supports a company that is now competitively priced. 2022 sees 280 million of revenue, although that will represent minus 25% year-on-year growth. Margins are healthy. It will give them 37 million, or near enough 37 million of profit, and EPS at 0.1. There is room for asset price growth, although breaking 2021 highs is certainly some way off, if ever. Next up is my favourite sector, as I'm sure everybody knows, a company called MULLEN, which operates as an electric car company. It's another suffering along with the wider industry. Sustainability and supply chain issues on top of the inflationary concerns are the real headwinds that not just this company is facing, but the sector as a whole. The stock briefly traded below $1 in February, and that's from highs of $13 only a few months ago. The stock has rallied on the back of a Yahoo Finance feature where progress on solid-state battery technology was well received. The balance sheet begins to show just how speculative this play would be. The stock is even at today's price of 290. Expensive, I think, is the word I would use. Market cap in 2017 was 43 million, while 290 would represent a market cap of 550 million right now. Yet the metrics between 2017 and 2022 are very, very similar. There's just very little going on the balance sheet in terms of revenues. Full year numbers show net losses ranging from minus 10 million to forecasted plus 4 million, but that covers a period over kind of 10 years, 2014 to 2024. So you can see the company just isn't really doing much at all. And again, that fits into the whole hype of the sector. A share price under $1 might seem cheap, but it's so speculative and so risky, you would really want to be seeing a share price of around about 40 to 50 cents to really get involved in the stock. There is huge upside potential, but there's, like I said, huge risk at the same time. So that's it for another week. I think the key message again from this week is markets are just at the point of getting a little bit ahead of themselves again. We have an awful lot that is now not priced in on both the geopolitical situation and on the monetary policy situation. The volatility will remain elevated for quite some time. I think on the whole, where we're at now will very much be, if you look at world indices, the number where we'll be at year end. So you can see the risks that begins to involve. For those getting involved now, your margins or your growth numbers that you would want to see are basically stripped away right now. It would be, you're kind of looking at 9 months of dead money. So again, and I know we keep trying to reiterate this, it's just a time for patience. Markets will certainly come back once again, and we will try and support you guys when it's the right time to make stock purchases. I would simply say that now really isn't the time, and wishing everybody a really good week. Thank you.